Money management can be a daunting task for many of us, but do not fear. By following these six rules to manage your money, you will be able to take control of your finances and set yourself up for a better future. Hey guys, my name is Rishabh Shah, and if you're just starting out your career and wondering how to manage your money, then you have come at the right place. By following these six rules, you will be able to begin your financial journey with. Also, if you want a written version of this six rules, then I have created an absolutely free e-guide and you can download it for your reference. I will just post the link in the comment box below. So let's begin. Rule number one. Are you struggling with budgeting? Then use the 50-30-20 rule. This rule suggests dividing your income into three main categories, that is needs, savings and wants. Use 50% of your income towards needs, your basic living needs such as housing, utility, groceries. Use the next 30% on your wants such as entertainment and traveling. This 30% allows you to enjoy the fruits of your hard work. And the final 20% use it towards savings and financial goals such as investments, insurance premiums, or debt repayment. The last 20% helps you to build wealth over a long period of time. This rule provides a balanced approach towards budgeting, and of course, you can always tweak these percentages depending on your circumstances and financial goals. However, try to save at least 20% of your income, and the more you can save, the better it is. Rule number two, 6x emergency fund. So, this rule suggests saving an amount equal to six times your monthly expenses separately in an emergency fund. So, in case your monthly expense is 50,000 rupees, then save at least 3 lakh rupees separately in an emergency fund. This fund will be useful for you in case of any unexpected financial challenges or income disruptions. So, it can be anything like major medical expense or house repairs, or God forbid, in case you lose your job, then this fund will be useful for you. So, you can save this money in a fixed deposit or a liquid fund where it is easily accessible. The purpose of this fund is to not generate any high returns or anything like that. The purpose of this fund is to be able to use that money any time of the day in case of an emergency. Rule number three. Are you confused about how much you should invest in equity and how much you should invest in fixed income? Then you can use the 100 minus age rule that helps you to determine how much you can invest in equity based on your age. So simply subtract your age from 100 to get the percentage you should invest in equity. So if you are 25 years old, then subtract 25 from 100, which is 75, and you can invest 75% in equity and the balanced amount in fixed income. As you grow older, the allocation towards fixed income will keep increasing, bringing stability in your portfolio. This rule is based on the assumption that as you grow older, your risk taking capacity reduces and then you start needing stability in your life. On the contrary, if you are younger, you can take higher risk, and that is why your allocation towards equity will be the highest when you are young. Rule number four, 20x term insurance rule. So, if you're wondering how much term insurance coverage you should have, then follow this rule. This rule suggests having a coverage of at least 20 times your annual income. So, if you are earning 5 lakh rupees a year, then have a coverage of at least 1 crore rupees. So, of course, this number can depend on various factors such as how many financial dependents you have, or any debt obligations you have, or any other financial obligations. Remember that the earlier you buy a term insurance policy, the better it is. The premiums of these policies are dependent on your age and health conditions. So, the earlier you buy, the cheaper it will be throughout your life. So, buy your term insurance policy now if you don't already have one. Rule number five, and my favorite rule, 15 into 15 into 15. If you want to make 1 crore rupees by investing small amounts, then you can follow this rule. This rule suggests considering an investment of 15,000 per month at a rate of 15% for 15 years. At the end of 15 years, your total wealth will become over 1 crore rupees. Now consider extending your investment horizon by another 15 years. So in this case, you are investing for 30 years instead of 15 years. Then your total wealth will increase to 10 crore rupees. It becomes a very, very large sum. This rule leverages the power of compounding, turning small, consistent amounts of money into a very large sum over a long period of time. The earlier you start investing, the better it is, and more the time your money will have to compound. Rule number six, the rule of 72. Wondering when your money will double? Then use the rule of 72. It is a straightforward method that will help you to understand how many years it will take for your money to double depending on the interest rate. Simply divide 72 by the interest rate. So if you are getting 8% ROI, then divide 72 by 8, which will give you 9 years. So it will take 9 years for your money to double at the rate of 8%. So this is not an exact outcome, it is a rough estimate and it is used for quick mental calculations. It will help you to understand the impact of different interest rates on your investments. These were the 6 rules to manage your money, and if you can get good at it, then you will be able to achieve your financial goals. This might sound a little bit overwhelming, but don't worry, we are in this together. And if you have any doubts, feel free to ask me or feel free to connect with me on my various social media platforms. I will post the link in the comment box below. Also, remember to download the free e guide that talks about these 6 rules, and you can save it for your reference. Also, finally, if you like this video, please click on the like button and please subscribe to my YouTube channel.